This conference will now be recorded.
All right, good afternoon and welcome to the Clear Lines training session. I'm your host, Kipp Cohen. It is Thursday, the 8th of August, 2019. This is a twice weekly training session geared for the subscribers of the Clear Lines indicator running on the MedVed Trader platform, or for those individuals interested in learning more about Clear Lines. The session is recorded and will be posted later today to the equity-alerts.com YouTube page. Your questions are always appreciated. If you could submit them through the GoToMeeting player, I would appreciate it. You're also welcome to email me, kip@equity-alerts.com, or you can even text me on my cell phone at 972-841-8886. Easiest is just to send me a message through the player, through the GoToMeeting player. So normally, we kind of go into Clear Lines and the MedVed Trader platform, and it's usually more about just how to utilize the platform and the indicator on the platform, and that, I'm welcome your questions if anybody happens to have a specific question today about MedVed Trader or about Clear Lines. I'm definitely going to answer that. But one of the things I wanted to do, since I've been talking the last couple of sessions more about trading options, and specifically been talking about options on QQQ, I felt like it might be a good day just to go kind of over some of the real basics of options, and then show how to pull up options on the platform, and how to make a decision what is the right choice when you're buying a put or a call. So, and I don't have a real set plan for this. I'm kind of just gonna go through what I know and share that with you guys. Okay. I mean, I have a few important points I want to touch upon, but overall, I just want to kind of get through some of the basics of options, and kind of go from there. So one of the tools that I wanted to share with you guys, if you have not been to this website, is the Chicago Board of Options Exchange, CBOE, which is a very great resource for options trading. And if you are new to it and you've never traded options before, I would encourage you to utilize their educational site and do some of their training. There's no cost to do their basic training. It's going to cover definitely a lot of the important basics that you need to know about options. And I do think it would be worthwhile. So you can click on the education tab, and then that's the Options Institute. They have a get started. You need to log in and get set up. They actually have an assessment to see where your level is at. And then you can go in and learn through the different levels once you know kind of where you're at. So I haven't logged in, but I don't think I've ever gotten set up with him. But again, if you're new to options, you've never traded them before, this is probably a resource that's going to be really good. And again, I would encourage new traders to the options world to go through their educational system. Okay. So what is an option, basically? An option is a trading instrument that gives you the right, but not the obligation, to buy or sell a stock at a certain price within a certain period of time. Okay? Gives you the right, but you're not obligated to buy a stock at a certain price by a certain period of time. So think of it this way, it gives you the ability to control more shares of stock without actually having to buy it at a much less or lower price. So one contract is equal to 100 shares of stock. So if, let's say I want to trade options on the Qs, so from my charts on the MedVed Trader platform, I can right click and go to the option chain for the Qs, okay? So there are literally thousands of different options out there. I mean, on an individual stock, there can be hundreds or more options because you have options that are at certain prices. So like right now, the Qs are trading at 187.50, okay, or 187.76. So I can buy an option that gives me the right, but not the obligation, to buy QQQ for $188, and it's going to cost me right now 80 cents times 100 because it's equal to 100 shares. Okay. So to buy one contract of, or to control 100 shares of the Qs would cost me $80 right now. $80 versus if I bought 100 shares of the stock, it would cost me 18,000. Now, this option expires tomorrow, so it's cheap. Okay. Options have an expiration. You'll see a date right here, August 9th, August 16th, August 23rd, August 30th. So they go out in time. You can buy way out in time too. You can buy options that are good for months or even years. Further out years are called leaps. So I could buy that same option for the 188 call for January of next year will cost me $9. So it's still cheaper, 9 or 9,000 if I wanted to buy not right, 972. Or is that $972? Is that right? Am I calculating that right? Yeah, $972 to control 100 shares of the Qs at $188. Yeah, 972. I thought so. For next year. So obviously if you're buying a call, you're you're looking for the stock to go up. So if the stock goes up to $200 by then, okay, that's $12 of in the money. So that could be worth $1,200 by that point if the stock is at that price. So there are two types of options, puts and calls. Calls, you buy in anticipation of the stock going up or appreciating. Puts, you buy with anticipation of the stock to go down. Okay, those are the two types of options, puts and calls. There are trades that are variations of buying different puts and different calls. And I'm not going to go into spreads and straddles and strangles and iron condors. There are different types of combination option strategies. That's a very advanced. The very basic is either buying a put or buying a call, or if you own the underlying stock and you want to collect a premium, you can sell somebody an option against your stock. That's it's like collecting rent on your stock. You're selling them. So let's say, and let's use Microsoft as an example this time. Let's say you own Microsoft at oops, hold on a second. There we go. Let's say you own Microsoft at $100, okay? And you've owned it for a while, and you want to collect a little rent on Microsoft. You could sell somebody an option. You could sell them an option that expires tomorrow, okay? The $140 call, the stock's trading 138. You could sell that right now for 17 cents a share. So if you owned 100 shares, you can get $170. Oh, $17, right? Hold on. Yeah, $17. $17 if you owned 100 shares. If you owned 1,000, it'd be 170. Sorry, if you sold 10 contracts. So thank you, David. So as long as the stock stays below $140 by tomorrow, at the end of the day, you keep that premium. Okay. And there are a lot of people that sell weekly options, sell calls against their stock and collect a little bit of premium every week. And as long as the option value is lower than the price of the, as long as the stock is trading below the option that you sold on the expiration date, you get to keep your shares. All right. If you sold the 140 and then tomorrow the stock's trading at 142, you have to give your shares to them at $140. They bought the right to buy your shares for 140. If that were to happen. Again, that's probably most people either buy a put, buy a call. Some people sell covered calls against their shares. So options, again, have different strike prices. Okay, so you can sell an option like if I want to go to next week on Microsoft, okay, the August 16th, the $143 right now, the $143 call, that's $5 away from where it's currently trading. So I could sell someone the right to buy my shares for 143 bucks right now for 23 cents, okay, or $23 per 100 shares. If I owned 1,000 shares of Microsoft, I could collect $230 in option premium, and then as long as it closes below 143 by next Friday, I get to keep that money. Okay, and you could do that again every week. Every week, you could basically collect rent against your stocks. So options have a strike price. That's the price of where you're anticipating movement near or towards. They have an expiration date. Okay. And most options, actually over 80%, I believe, of options expire worthless because it's out of the money, right? So right now, tomorrow, odds are, and you'll see the yellow is in the money, the white is out of the money. Odds are most of these options right now in the white are going to expire worthless tomorrow. They'll have zero value, the calls. And these puts, there's a high probability these will expire worthless. So again, remember, all an option is a right, not an obligation, to buy or sell a stock at a certain time within a certain price. Now, there's some important aspects of options that you need to know. First of all, they have a spread just like a stock, a bid and the ask. So an illiquid stock is going to have a big spread between the bid and ask, and you on the option, and you probably don't want to trade options on illiquid stocks. They're very difficult to trade. You want to stick to stocks that have a high volume and that the options behind them have high volume as well. There's a couple pieces of information you can look at. So you'll see on my chart, you see the bid and the ask. So an option that has much more than 3 or 4 cent spread between the bid and ask, depending on the price of the stock, obviously. I mean, some options on stocks have a bigger spread, like Amazon or a Google. They're going to have a real big spread because of the price of the stock. But the further you get away from an option that's right trading near the current value of the stock, the bigger the spreads are going to get. You try to want to stick to options that have a pretty tight spread between the bid and the ask. So you can see right here, the spread is just a couple of pennies, 2-3 cents. And you can see it's got decent volume. It's traded 5,600 contracts today. And there's a lot of open interest, 3,500 contracts in the open interest. So the volume, that would be the number of contracts that's traded. You know, if it's ideally options that have a volume of 500 to 1,000 or more are ideal. You could go as low as 100 as long as you're only trading 5 or 10 contracts. And then the open interest would be potential options that are out there available to be bought or sold, the open interest. One important number that you want to look at is what's called the delta. And if you don't have it up, you'll have to add it to your chart. You just right click on the top column, put your mouse over there and go to the column chooser, and then find delta on the list, which I already have up here. And then you drop it and drag it. And I'll do something else so you can see how to do that. I'll do a gamma. So then it brings it up. So you see I have delta. I'm going to remove gamma. Delta is a very important number. It is going to let you know how much that option moves in relationship to the price of the stock. So, because depending on what you're trying to do, if you're trading an option shorter term, you know, if you're trading intraday or over 2 or 3 days and you're looking for it to move fairly fluid with the price of the stock, then you'll need an option with a higher delta. So ideally, if you want an option to move fluid with a stock, you would want something around an 80 delta or higher. Okay, so right now on Microsoft, the 136 option has a delta of 82. So if you wanted to, instead of buying Microsoft for $138 and you wanted to buy 1,000 shares, okay, you could buy 10 contracts of the 136 call for $2.38 or $2,380. So you're going to control 1,000 shares for $2,300 versus 138,000, and it's going to move about 80% in relationship to the price of the stock. So if the stock moves up $1, that option should move about 80 cents. That's what the delta means. Okay. So the further you get into the money, so there's in the money, at the money, and out of the money options. The more in the money, the more expensive the option is because it has what's called intrinsic value associated with it. The further in the money, the higher the price of the option and the higher the delta. At the money options are typically going to have a delta right around 50%, 0.5, which means for every dollar the stock goes up or down, that option is going to go up or down about 50 cents. If you've ever heard someone say, I'm going to buy a lottery ticket on XYZ stock, they're going to buy a out of the money option, okay, that's really cheap, but the stock has to make a very big move for that to appreciate in value. So it's like buying a lottery ticket. So in other words, the odds, if I bought the $141 call on Microsoft for tomorrow, it would cost me 6 cents, okay, per share, basically. So 6 times 100 is cheap. It's like buying a lottery ticket, right? $6. But there's a very low probability that that is going to actually happen. And you can use the delta as a probability, kind of figuring out probability of if it's going to expire worthless or in the money. Options that have a really low delta, 0.1, you know, point one or less, have a very low probability of being worth something. 90%, 90 plus percent chance that it's going to expire worthless. Okay, think of it that way. Think of the inverse number. So if I buy a 0.95% option, there's a 95% chance it's going to probably expire in the money. High probability. When you get towards the at the money, that's about 50-50. Okay, right? 50-50 chance that's going to expire in or out of the money if it's at the money tomorrow. As you start getting out of the money options, that delta starts dropping dramatically. So like the 139 call expiring tomorrow has a low probability of has a high probability of expiring worthless, a low probability of expiring in the money. 34 delta, meaning about 65% chance it's going to expire worthless. Okay, does that make sense? Any questions so far about this? So depending on what type of trade you're going to do, will dictate what type of option you're going to buy. If you're trading actively, okay, day trading, swing trading, you're going to need an option that's either at or in the money, okay, depending on the stock. If the stock's got a pretty good trading range and moves around pretty well every day, you can get by with about a 50 delta. That's probably the minimum. If you want that to move pretty fluid, again, you want 75, 80 delta so that it moves almost in tandem with the stock. If you are doing a longer term trade and you're speculating that the stock, you've been looking at charts and you think in the next 3 months, if you think Microsoft is going to get to $150 in the next 3 months, you could buy an out of the money. Let's go to October. Okay, October. If I thought that Microsoft was going to be above 140, okay, by October 18th, and it's got to at least be a few dollars. It's got to be a little higher than that because I have time value right now. So there's time value, which is part of the of what you're paying for. That's part of the premium. Intrinsic value. That's the other part of the premium. So the time value, that's a big part of the further out you buy. The further out in time, the more expensive the option because somebody has to take the other side of that trade. So they need to, they're taking the risk. They're taking the risk that, they may have to give you shares at $140 in October. So if they have to give you their shares at 140 and the stock's trading 145, they're going to potentially lose some money. So further out in time, you pay more for that value. But let's say you thought that Microsoft was going to be trading well above 140 by October, and you didn't want to spend $138 a share. You could spend $4.80 per share, buy the 140 October option, and with anticipation that it's going to get above that level. That would be a longer term option. Of course, it's again a lot more expensive. So you could go another strike out if it depends on where you think it's going. But people will buy, and that's got a 46 delta on it right now. You could go to the 145, spend 266, but the delta is only 31. So it's not going to move as fluid with the stock, and there's a higher probability that that one's going to expire worthless. So shorter term trading, actively trading and swing trading, again, you want higher delta, preferably higher volume, tighter spreads between the bid and the ask. Further out trades, you can go a little lower, little lower delta, your little lighter volume, as long as it's trading at least 100 or 200 contracts a day, and you're not trading more than 10 contracts. Again, just depends on what you're looking at. So let's pick another stock, just as an example. Here, we'll pick Western Digital. So I'm going to go to the daily chart on WDC so I can see the ATR. I have the ATR down here. It's about $2.48. So this stock moves around about $2.50 a day. If I was to buy options, go to my option chain. All right, so we talked about calls. Let's talk about puts. So looking at the chart right now, WDC is way up at the highs. It's up 4%. It's trading pretty much up at the top of its ATR. So let's say I was anticipating that WDC was going to go down this afternoon or tomorrow. Okay. I am anticipating I've reviewed the trends. It looks like it's a weak trending stock, and I think it's going to go down. Okay. I can buy a put option with anticipation that the price is going to go lower. Put goes up in value as the price of the stock goes down. Call goes up in value as the price of the stock goes up. It goes down with the price of the stock going down. So let's see. WDC is trading at 55.15. So the 55.50 put is above the current price. It is in the money. Okay, because you're saying I think I want to sell it at 55.50. I'm selling or shorting WDC at 55.50. So I could sell an option on. I could buy a put in anticipation of WDC going down for 74 cents. Now the only problem is look at the volume. Only 4 contracts traded today, and the open interest is 100. So it's a little light on the volume. Again, at least 100, preferably 200. So maybe we have to go to the next week. Is there more volume? No, it's pretty light over there too. So this may not be a good one to do an option on. When the volume is very light, you might have trouble getting in or getting out. There's open interest there, but the volume's light. So, and here's the interesting thing. The last trade was at 202. It's currently 69/72. So someone probably bought a put this morning and now it's for $2 and now it's only worth 69 cents. They bought the put when WDC was really low. See, they've lost a lot of value in that option. Now, what some people will do, they will, instead of buying a put with anticipation going down, they will sell a put to somebody else in the hopes of buying the shares of stock at a cheaper price. So, because think of a put means the shares are going to be put to you for the seller. If you sell a call to somebody, your shares might get called away. Okay. So if you sell a call, you might get your shares called away. If you sell a put, the stock might get put to you. That's how you remember. If you sell a call against your stock, your shares might be called away. If you sell a put to somebody, the stock might get put to you. It is an interesting way to be able to buy stock. So let's say I'm going to use a really good example. Let's say I really like Amazon. Okay. I want to own some shares of Amazon. Okay. I'll show you something interesting. Hold on. Okay. So let's say I want to own Amazon. It's currently trading at $1,827, but I don't want to pay $1,827. I only want to pay $1,810. Okay. I want to buy 100 shares of Amazon. I'm willing to pay $1,810 a share right now. Well, the stock's 1827. That's okay. I'm willing to pay 1810. So I could sell a put for $3.40 right now. Okay. So I could collect $3,400. Okay. Because that's times 100 for 100 shares. I could collect $3,400. Now, as long as Amazon is above 1810 by the close of trading tomorrow, I get to keep that $3,400. And I don't have to buy the stock. I'm not obligated to buy the stock because that option is going to be worthless by the end of the day tomorrow. That option that I sold for 345, if Amazon closes at 315 tomorrow, that option will go to zero because why would I want to buy it? Why would anybody want to buy it at 1810 if it's trading at 18? I mean, hold on. Did I do that wrong? Right. Why would anybody want to sell me the shares for 1810 when they can sell it on the open market for 1815? Sorry, I was backwards. Okay. If it closes at 1815, nobody's going to sell me their shares at 1810 because they can get it 1815 on the open market. So that option will go worthless by tomorrow. So now, if Amazon is at 1805 tomorrow, I'm obligated to buy at 1810. But I was willing to. Okay. I have to buy those 100 shares for $1,810, even if it's at 1805, because of I sold someone the right to sell me their shares for 1810. And if the stock is at 1805 and they have a contract from me that I will pay 1810, they're going to make me take that contract unless I buy back those options. And then that costs me $5. So I would lose $1,400. So what happens is there are some people that will sell put options because they want to collect that premium and they don't mind buying the stock at a lower price than where it's currently trading. It's an interesting concept. Actually, the options traders that make the most are the ones that are selling the puts and the calls, because there are so many more that are out of the money that end up going worthless. The people that sold all those puts and calls that end up worthless on Friday keep the premium, and you got nothing for the person that so if somebody buys that put for 370 and that 1810 put for 370, and the stock, because they anticipate it's going to go down tomorrow, and the stock doesn't go below 1810, that 370 they just spent is zero. It becomes zero. Any questions about that? Oops, hold on. I think I'm missing questions. That's the old Jared Levy's Slumlord Millionaire play. How do you know which option to get at a good price? So it's not necessarily, sorry, I didn't see there were questions. They weren't scrolling, so I missed it. Sorry, Norm. So don't 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 always look at, don't think I got to get the best price option. It's not about, it's about um, buying the right option. Okay. It's important to buy the right option. Don't buy it just because of the price. Buy it because it's right. Buy it because it's got good volume, it's got a good spread in the bid and the ask, it's got good open interest, and it's got a good delta. Okay. Because the delta, oops, I lost my delta. I don't know where it went. There we go. The delta, again, is going to dictate how it moves in relation to the stock. So we talk a lot about the Qs because that's something that I've been trading. And there's some advantages to trading the Qs. Okay, so the advantages are they trade in 50-cent increments, right? So your strike prices are every 50 cents versus some that are $1, some that are 2.50, some that are $5 or more, depending on the price of the stock. So you have 50-cent increments, okay, on the strike prices. You have lots of volume, lots of open interest. Hold on. Where do I want the delta? Okay, right there. All right. They're very fluid. The Qs have a pretty good range. So, um, a delta of 50 or higher is going to move around pretty nicely, and they're reasonably priced. So I could, if I think the market's going to bust a move and keep going higher, I could buy the 188 call on the Qs. Look at the open volume today, 10,000 contracts. So I could buy next Friday's options for 2.25 right now. So 10 contracts would cost me $2,250. That would be like controlling 1,000 shares. Plenty of volume. There's a decent delta. It's going to move fluid with the price of the stock. Now, as time goes on, if the value of the stock doesn't go up, that delta is going to start to shrink because that delta has to do with time value and intrinsic value. Intrinsic has to do with how much it is in the money. So right now, that 188 is just starting to get into the money because the stock is at 188.07. So it's 7 cents in the money. It's got 7 cents of intrinsic value. It's got $2.17 of time value. So as time goes on, if the price of the stock does not appreciate, that time value is going to slowly eat away. That it will disappear. So you need the stock to keep moving for that to get in value. But remember, if you're trading actively, you need something at or in the money. Okay, so that's right in the money right now. That 188 is just a few cents, about 12 cents and 13 cents in the money. It's got good volume, it's got good open interest, and it's got a decent delta. Does that make sense? Yeah, again, don't worry about specifically the exact price. You're going to pay, um, you're going to pay um, uh, basically a small percentage of compared to the price of the stock. Now the difference is, again, you're not buying an actual stock, so if the stock goes down $1 in a week, you could still own the stock because it could go back up $1 over the following week. If you buy an option for next week, the stock goes down $1 and you bought an at the money option, by next week that option is going to be worthless. So you're going to lose that money. How do you not lose your delta column when you? Yeah, I don't know why I'm losing it. It's supposed to stay, and for some reason it's not. It's not supposed to go away. I don't know why sometimes it does that. Let me try again to open up option chain. Yeah, it's still there. It should be there. Sometimes it does that. But you definitely want to see where the delta is. All right, so again, let me kind of recap a little bit of what we've discussed. You would buy a call option at or in the money if you anticipate the stock to go higher, and if you're trading it more actively, 50 delta or better. You would buy a put option. You would purchase a put option if you anticipate the price of the stock to go down, again, buying at or in the money. And the yellow is going to show you if it's in the money. Yellow is in the money. White is out of the money. So in the money, at or in the money, 50 delta or higher, decent volume, decent open interest. You buy a put if you anticipate the price to go down. So like I bought a put on the Qs for tomorrow. I bought the 187 put option. Okay. Right now the stock's at 188. I'm $1 away from the money. Tomorrow, if the stock is not trading below 187, that is going to be a worthless option. I was looking for a pullback. Could happen in the morning, don't know. It hasn't happened yet today. I didn't think the market would keep going, but I took a very small risk. I only bought 5 contracts. I paid less than $1. So I have a little less than $500 at risk in the trade. I knew my risk. If the market continues higher, that option will be worthless tomorrow. It still has value to it because it's got time left. But right now, that 187 put is worth 50 cents. So I could still sell it and make back about half, a little over half of what I invested in it. But again, my thoughts were hold overnight with anticipation that we would see some level of a pullback in the market. When I switch the stock symbol on the option screen, the delta column stays. When I open a new option screen from a chart, I don't get the delta. Yeah, I'll have to talk to the MedVed guys and see if they can figure out why that's happening. And unfortunately, for the time being, until I can get them to correct that, you'll have to just put it back in there. I don't know why it does that. Yeah, if I go to a different, if I close it and go to a different symbol, it goes away. It's probably some glitch. I'll have to let them know. Thank you, Norm. Um, as you get more advanced in the options trading, oh, by the way, you would need to check with your broker, and if you don't have permissions, you would need to request permissions for options trading. Usually, they're only going to give you initially the ability to buy or sell, buy a put or call. Okay, the buying and selling of puts and calls. They're not going to give you the option to be a seller of the, to do advanced strategies like spreads, straddles, strangles. Most likely just be able to buy a put, buy a call. They'll probably give you covered if you own covered call as well, ability to sell covered calls. And initially, really, that's all you want to do. Stephen gets into some of the more advanced option strategies, straddles, condors, spreads, and that's a little beyond my knowledge base, and not something I really do or want to get into. I like the leverage of an option, and I like that, for a lot of traders out there that have smaller accounts, you can risk a lot less to control a lot more, and that's the leverage. Do the day trade rules apply? They do apply. So if you're trading in a margin account, then you can only make 3 option trades over a rolling 5-day period. Now, if you hold overnight, then you're in the clear, but you can only technically make 3 over a rolling 5-day. The one thing that you could do is, let's say you had 10,000 to trade with, you could split 5,000 into 2 different accounts, trade one account one day, trade the other account the next day. Then you're limited to 1 trade a day. If you trade in a non-margin account, then I think the rule's a little different. You can just trade through the amount of cash you have, because options clear the next day. So if you had 5,000 in and you traded, I think this is right. You need to check with your broker, but you could make 3 or 4 trades of 1,000 each, I believe, and then you could do again the same thing the next day. But let me confirm that to make sure. I can't remember. Does anybody know for sure about that? I can't recall. Norm says, can you show exactly what current option trade you have on the queues and explain? Yes. So I currently have the 187 put. So I bought it when we were right in rolling over. I think it was right in here. Hold on. 1157. No, hold on. Yeah, right after we were topping out right up in here. Is that Eastern or Central? I can't remember. The Qs were way up above their range, way overextended. And as I was looking at the charts, and I have to look at a different chart to show you, but hold on, there we go. Let me go to, yeah. So yeah, it was right in here. There was this double top right here. Yeah, it was right in here. There was a double top, and I was looking for a pullback starting today, going into tomorrow. So what I did was, and I knew it was a higher risk trade because of the strength of the move today. So I said, whatever am putting into this is at risk. It's a full risk trade. I'm risking $490. Okay. See, if something negative happens overnight and the market's open down tomorrow 1%, then that'll thing will be in the money. But so it was a smaller risk trade, knowing that I could lose the whole $490. And I said, I'm going to hold overnight because in case we don't pull back this afternoon, I'm looking for that move to happen tomorrow to see some profit taking. It definitely was a higher risk trade, and but I limited my risk. I wouldn't have done it with a couple $1,000. Again, it was a much smaller risk. There's still value in it. So depending on the time of the day and where the market is, I potentially could still get out with some of my money. Chances are, if the market gaps up tomorrow, it's going to be worthless. I'll be lucky to get anything out of it. So it was kind of an all or none trade. And if you recall, last Thursday, I did something similar, and the market sold off dramatically. Wasn't anticipating a huge sell-off this afternoon like last Thursday, but I was thinking we would see some level of a pullback, which we just haven't seen. So that was some of the reasoning behind it. And obviously we haven't. We're still grinding higher. So again, a limited risk. The reward depends on if the market pulls back or not. If we see a nice, at this point, for it to be a good reward, the Qs tomorrow is going to have to get down to about 186. If it gets down to 186, and I have a dollar of intrinsic value, then I'll make 500 on the option. I'll double my money. Well, I'm going to lose the time value, so I'll break even. So it really needs to go lower than that. It's going to have to go down to below 186. No, yeah, 186. I break even tomorrow. I figured we would start seeing a pullback this afternoon, honestly. I only did 5 contracts. 5 contracts. So the max I can lose is $490, my investment. And look at this. They're ripping into the close. Did not see this coming. All right. Any more questions? Pretty much out of time. Any further questions? So 5 contracts is equal to 500 shares. 1 contract is 100 shares, equal to 100 shares. Every one contract is 100. 10 contracts is equal to 1,000 shares. So if I would have shorted 500 shares at 187, currently I would be down 500 and some odd dollars. Right now, on my option, I am down, hold on. $270 on that option. So I'm down half as much of what I would have been if I had the stock. So it's a limited risk. Cool. I'm glad you learned something. All right, guys, that's it for me. I want to thank y'all for tuning in today. I'll be back on Tuesday for another session with the clear lines. And thanks for tuning in. If you have any questions, you can email me, kip@equity-alerts.com. And some of you guys, I'll see you in the morning in the chat room. Have a good evening, and thanks for tuning in. Bye-bye.